every single day, without realizing it. Most people make one small money mistake that quietly keeps them poor. It doesn't look dramatic. It doesn't feel dangerous. In fact, it feels normal. That's why it's so powerful. This mistake hides inside daily habits, small purchases, ignored decisions, and delayed actions. Over time, it compounds, not in your favor, but against you. And the worst part? Almost everyone believes they're being responsible while repeating it. The daily money mistake is not about how much you earn. High income doesn't protect you. Many people with large salaries are still financially stressed. Why? Because the real issue isn't income, it's behavior. Wealth is built through patterns, not paychecks. If your daily pattern moves money away from assets and toward liabilities, your financial future slowly shrinks. Income can increase, but poor patterns quietly cancel progress. Most people focus on saving what's left after spending. Wealthy people do the opposite. They invest first and spend what remains. That small reversal changes everything. When you treat investing as optional, it rarely happens. Life always presents another bill, another desire, another necessary expense. But when investing becomes the first priority, your lifestyle adapts automatically. This one shift transforms your financial trajectory. The mistake is emotional spending disguised as reward. I worked hard. I deserve this. It's only a little. Individually, these decisions seem harmless. Collectively, they drain thousands every year. Emotional spending creates short-term comfort and long-term pressure. The brain loves immediate pleasure and ignores distant consequences. But wealth requires the opposite mindset. Short-term discipline for long-term freedom. Another form of the daily mistake is delaying investment while waiting for the perfect time. People wait for markets to drop, for salaries to rise, for debts to disappear completely. But time in the market beats timing the market. Every month you delay investing, you lose compounding power. The earlier money begins working, the less effort you need later. Delay is more expensive than most realize. Many underestimate the silent power of small recurring expenses. Subscriptions, upgrades, impulse online orders. They feel tiny, but repeated daily or weekly, they become massive over years. If you redirected even a portion of that flow into assets, the outcome would look entirely different. The issue is not one large purchase, it's consistent leakage. Wealth grows from consistency, and so does poverty. Lifestyle inflation is another hidden trap. When income rises, spending rises equally or faster. Instead of building assets, people upgrade apartments, cars, and habits. It feels like progress, but financially nothing changes. True progress is increasing the gap between what you earn and what you spend. That gap, invested consistently, becomes independence. Without that gap, you remain dependent on your next paycheck. Fear also plays a major role. Many people avoid investing because they fear losing money. Ironically, by avoiding calculated risk, they guarantee slow financial stagnation. Inflation quietly reduces purchasing power every year. Money sitting idle loses strength. Investing involves risk, yes, but not investing carries a hidden, guaranteed cost. Understanding this difference separates builders from bystanders. The daily mistake continues when people rely solely on active income. They trade time for money and stop there. The wealth grows when money works independently of your time. Assets generate returns whether you are working or resting. Without assets, your financial growth stops the moment you stop working. That dependency creates stress and limits freedom. Finally, the most dangerous part of this daily mistake is that it feels normal, because everyone around you does it. Society encourages consumption, not ownership. Advertising pushes upgrades, not investments. If you follow the crowd financially, you will likely get average results. Breaking the daily money mistake requires awareness, discipline, and a decision to act differently, starting today. Another daily mistake is confusing activity with progress. People research, watch videos, read books about investing, but never take action. Learning feels productive, but without execution, nothing changes. Information alone doesn't build wealth. Action does. Even small, imperfect investments beat endless preparation. The market rewards participation, not hesitation. Knowledge becomes powerful only when applied consistently over time. Debt is often treated casually. Minimum payments feel manageable, so the problem seems small. But high-interest debt quietly consumes future income. Every dollar paid in interest is a dollar that cannot compound for you. The daily mistake is normalizing interest payments as a permanent part of life. Strategic debt can build wealth, but careless debt builds financial chains that are hard to break. Many people underestimate the power of automation. If investing requires willpower each month, emotions will eventually interfere. Some months you'll feel confident, other months you'll hesitate. Automation removes emotion. When investments happen automatically, discipline becomes effortless. The daily mistake is relying on motivation instead of systems. Wealth is usually built through systems, not bursts of inspiration. Short-term thinking keeps people stuck. Decisions are made based on this week, this month, this year. But investing rewards those who think in decades. When you zoom out, market drops look small, trends become clearer. Patience becomes easier. The daily mistake is reacting emotionally to short-term no's, instead of committing to a long-term strategy and trusting the process. Another silent error is comparing your progress to others. Social media highlights luxury, not balance sheets. People see vacations, cars, and expensive lifestyles and feel behind. Comparison fuels unnecessary spending just to keep up. But true wealth is invisible. It's assets, investments, ownership. The daily mistake is chasing appearances instead of building foundations that actually create freedom. Many believe investing requires large sums of money. This belief delays action for years. In reality, consistency matters more than size. Small, regular contributions grow significantly through compounding. Waiting until you have enough often means never starting. The daily mistake is underestimating small beginnings. Almost every large portfolio started with modest, disciplined contributions. Lack of clarity also hurts progress. If you don't define financial goals, money drifts. Spending becomes reactive. Investing feels random. But when you set clear targets, financial independence, retirement age, passive income level, decisions gain direction. The daily mistake is operating without a financial roadmap. Clarity creates focus, and focus creates measurable progress. Ignoring risk management is another problem. Some people avoid investing completely. Others invest recklessly without diversification. Both extremes are harmful. Balanced portfolios manage risk while pursuing growth. The daily mistake is thinking in extremes instead of strategy. Wealth building is not gambling, but it's also not hiding. It's measured, thoughtful participation in growth assets. Impatience destroys compounding. Many start investing but quit after small fluctuations or slow growth. They expect quick results and lose confidence. Compounding is slow at first and powerful later. The early years feel insignificant. The later years become exponential. The daily mistake is quitting before the curve accelerates. Patience is one of the highest return financial skills. Ultimately, the daily money mistake is choosing comfort today for freedom tomorrow. Small pleasures feel urgent. Investing feels distant. But every financial decision shapes your future self. Each day you either move closer to independence or further from it. The choice rarely feels dramatic, yet its impact is enormous. The real power lies in daily discipline and long-term vision. One overlooked mistake is ignoring income growth while focusing only on cutting expenses. Reducing spending helps, but there is a limit to how much you can cut. Income, however, has far greater upside. Failing to improve skills, negotiate salaries, or explore additional income streams slows financial progress. The daily mistake is staying comfortable instead of increasing your earning capacity over time. Many people treat bonuses, tax refunds, or unexpected income as free money. Instead of investing it, they spend it quickly. Because it wasn't part of their regular salary, it feels extra. But this extra money has enormous potential if invested. The daily mistake is consuming windfalls instead of converting them into long-term assets that generate future returns. Another silent problem is ignoring financial education entirely. School rarely teaches investing properly, so people rely on opinions from friends or headlines. Without understanding basic principles, fear and confusion dominate decisions. The daily mistake is staying financially passive. Even a small effort to learn foundational concepts can prevent costly errors and increase long-term confidence. Procrastination often hides behind perfectionism. People want the perfect portfolio, the perfect strategy, the perfect entry point. The perfection delays progress. Markets reward consistent participation more than flawless timing. The daily mistake is overcomplicating simple strategies. Often, steady contributions to diversified investments outperform complex, emotional decision-making over time. Inflation is an invisible force many ignore. Prices slowly rise, but salaries don't always keep pace. If your money sits idle in low-yield accounts, its purchasing power shrinks. The daily mistake is thinking stability equals safety. True safety often requires growth that outpaces inflation. Otherwise, your money quietly loses value year after year. People also underestimate taxes. Poor tax planning can reduce returns significantly. Ignoring tax-efficient accounts or strategies means giving away a portion of growth unnecessarily. The daily mistake is focusing only on gross returns while neglecting net results. Smart investors think about what they keep, not just what they earn. Emotional reactions to market news cause costly decisions. Headlines are designed to trigger fear or excitement. Reacting impulsively leads to buying high and selling low. The daily mistake is allowing external noise to control internal strategy. Successful investing requires calm consistency, not constant adjustment based on short-term events. Many fail to track their finances clearly. Without reviewing expenses, investments, and net worth, progress remains invisible. What you don't measure, you can't improve. The daily mistake is avoiding numbers because they feel uncomfortable. Awareness creates accountability, and accountability creates better decisions over time. Another issue is undervaluing time. Young investors often believe they can start later. Older individuals sometimes believe it's too late. Both assumptions limit potential. Time is the most powerful compounding tool available. The daily mistake is misunderstanding how dramatically early or consistent investing can change outcomes. Finally, people underestimate discipline. They search for secret strategies, advanced tools, or insider knowledge. But wealth is rarely built through secrets. It's built through boring consistency. Investing regularly, spending wisely, staying patient. The daily mistake is chasing excitement instead of committing to simple habits that quietly create extraordinary results over years. Many people ignore emergency funds, assuming nothing unexpected will happen. When a crisis appears, they rely on credit cards or sell investments at the worst time. This interrupts long-term growth and increases stress. The daily mistake is failing to prepare for uncertainty. A solid emergency reserve protects your investments and keeps your strategy intact during difficult periods. Another hidden error is believing that one big financial decision will fix everything. People search for a single winning stock or breakthrough opportunity. But wealth is rarely built through one dramatic move. It grows through repeated, steady actions. The daily mistake is overvaluing rare events while underestimating consistent behavior. Some individuals invest without understanding their risk tolerance. When markets decline, fear takes over and they sell prematurely. This locks in losses and breaks compounding. The daily mistake is copying strategies that don't match your personality. A sustainable plan is one you can follow calmly during both growth and downturns. Ignoring diversification exposes investors to unnecessary volatility. Concentrating money in one asset or sector increases emotional stress and potential losses. Diversification reduces extreme swings and stabilizes progress. The daily mistake is chasing high returns without balancing risk. Stability often leads to better long-term outcomes and aggressive concentration. Many underestimate the power of habits outside investing. Health, focus, and productivity directly impact income and decision-making. Poor lifestyle choices can reduce earning potential and increase medical costs. The daily mistake is separating personal discipline from financial discipline. Both areas influence each other more than most people realize. People often assume financial freedom requires extreme sacrifice. This belief causes them to avoid investing altogether. In reality, balanced progress is sustainable. Small lifestyle adjustments, repeated consistently, create significant change. The daily mistake is believing it must be all or nothing. Gradual improvement often outperforms sudden, unsustainable effort. Lack of patience during slow growth discourages many investors. Early returns may appear small and unimpressive. This leads to doubt and strategy changes. The daily mistake is expecting visible progress too quickly. Compounding accelerates over time, but only if you allow it to continue uninterrupted. Another error is ignoring asset allocation adjustments over time. As goals approach, risk levels may need refinement. Failing to rebalance can expose you to unnecessary volatility. The daily mistake is setting a plan and forgetting to review it periodically. Smart investors adapt strategically, not emotionally. Overconfidence can be as dangerous as fear. A few successful investments may create unrealistic expectations. This can lead to excessive risk-taking or neglecting fundamentals. The daily mistake is assuming past success guarantees future results. Discipline and humility protect long-term growth more effectively than confidence alone. Ultimately, financial outcomes reflect repeated decisions, not isolated events. Each purchase, each investment, each delay matters. The daily money mistake persists because it feels small and harmless. But over years, small choices compound dramatically. Changing one consistent habit can completely alter your financial future trajectory. Many people underestimate the cost of indecision. Money sitting unused while you think about it loses momentum. Opportunities pass, compounding pauses, and inflation continues quietly. The daily mistake is believing that doing nothing is neutral. In finance, inactivity often has a hidden cost. Even a simple, basic strategy executed consistently is better than endless hesitation. Another issue is tying self-worth to net worth. When markets drop, confidence drops. When portfolios grow, ego rises. This emotional attachment leads to unstable decisions. The daily mistake is allowing identity to depend on financial fluctuations. Wealth building works best when numbers are treated as data, not personal validation or failure. Many avoid reviewing mistakes. Instead of analyzing losses calmly, they ignore them or blame external factors. Growth requires reflection. The daily mistake is refusing to learn from past financial errors. Every setback can provide insight that strengthens future decisions, but only if you're willing to evaluate honestly. Some people focus entirely on accumulation and forget about purpose. Money without direction leads to endless chasing. Clear purpose creates structure and discipline. The daily mistake is earning and investing without defining what financial freedom actually means for you. When purpose is clear, decisions become simpler and more intentional. Another common trap is relying on motivation instead of commitment. Motivation fluctuates with mood and environment. Commitment remains steady. The daily mistake is waiting to feel ready before acting financially. Successful investors act according to plan, not emotion. Consistency during uninspired days often matters most. Many underestimate the importance of environment. If everyone around you overspends and avoids investing, those behaviors feel normal. The daily mistake is not seeking communities or influences that encourage growth. Surrounding yourself with disciplined thinkers reinforces better habits and strengthens long-term resolve. There is also the danger of complexity. Some believe investing must be complicated to be effective. They create overly complex portfolios and strategies that are hard to maintain. The daily mistake is mistaking complexity for intelligence. Simple, diversified approaches held consistently often outperform complicated systems over decades. In the end, the daily money mistake is not dramatic. It's subtle repetition of small, comfortable choices that delay ownership, delay investing, and prioritize consumption. Change doesn't require perfection. It requires awareness and one decisive shift. Invest first, think long-term, act consistently. Over time, that simple adjustment can completely transform your financial destiny.